In a single morning, before most people finished their coffee, before the markets even opened their second hour, $1 trillion vanished, not lost in a crash that built over weeks, not erased by a war, a pandemic, or a collapse. Gone in 80 minutes flat. Silver didn't just fall, it bled. And the people who understood what was really happening weren't panicking. They were positioning. Because this wasn't random, this wasn't noise, this was a signal. And what it is signaling should concern every serious person watching this right now very deeply. Welcome to Financial Crisis Explained, the channel where we don't chase headlines, we decode them. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't retire without a pension plan. You wouldn't cross a busy road without looking both ways. So why would you navigate this economy without hitting that subscribe button? It takes 1 second. And trust us, the way things are moving right now, you're going to want to be here every single time we post. And one more thing before we begin, we're genuinely curious. Where in the world are you watching this from right now? Drop your city, your country, anything, right down there in the comments. Because this story we're about to tell you, it doesn't stop at any border. Now, let's get into it. The morning started like any other. Markets were open, traders were at their desks, coffee was still warm, and then, in the span of 80 minutes, the precious metals market experienced one of the most violent concentrated destructions of value in recent financial history. $1 trillion gone. Not over a week, not across a rough quarter, not through the slow bleed of a bear market that gives investors time to think, adjust, and reposition. 80 minutes. To put that number into perspective, $1 trillion is larger than the entire GDP of most countries on this planet. It is more than the annual economic output of nations with populations in the hundreds of millions. It is the kind of number that governments argue over for years in budget negotiations. And on this particular morning, the market erased it before most people had finished reading the news. This is where the story begins, not with opinions, not with predictions, with data. Gold moved first. In the early hours of the session, gold dropped approximately 2%. That may sound modest on paper, but 2% of gold's total market capitalization translated to roughly $740 billion in erased value, in a single directional move, inside a single trading window. For context, a 2% move in gold is not a fluctuation. It is an event. Gold is one of the most liquid, most institutionally held assets on the planet. It does not move 2% because of sentiment. It moves 2% because something structural is shifting underneath the surface. But gold was only the opening act. Then silver moved. And silver did not drop 2%. Silver dropped between 10 and 11%, in the same window, in the same 80 minutes. Western spot silver, which had been trading near the $90 range, collapsed to $79. Western futures landed at 81. For those tracking technical levels, and serious analysts always are, silver had been holding a critical support zone near the 150 exponential moving average on the hourly chart near the $90 mark. When that level broke, it did not crack slowly. It collapsed completely. And the analysts who had been watching that specific level already knew what a breach would mean, not because of guesswork, because of confluence. Multiple data points, multiple time frames, multiple market signals, all pointing toward the same conclusion simultaneously. The level was the level. And when it gave way, the market moved exactly as the data suggested it would. Now here is what most people missed. When the average person sees a headline like "Silver drops 10%, the instinct is to react emotionally, either panic and sell, or dismiss it as temporary volatility and do nothing. Both responses, in this context, are dangerous, because a 10% move in silver in 80 minutes is not volatility in the traditional sense. It is communication. Markets speak in price. And what silver said on this particular morning was not random. It was specific. It was loud. And for those with the framework to interpret it correctly, it was deeply instructive. The retail investor saw a number fall on a screen. The institutional analyst saw confirmation. This is the fundamental gap that separates those who build wealth through market cycles from those who lose it. Not access to information, because the data was public. Not intelligence, because the numbers were simple. The gap is framework. The ability to look at a $1 trillion event unfolding in real time and ask not what just happened, but what is this telling me about what comes next? Because the 80 minutes were not the story. The 80 minutes were the introduction. What built that collapse, the mechanics behind it, the institutional behavior that triggered it, the geopolitical pressure that accelerated it, that is what demands examination. And that is exactly where this analysis goes next. Because what happened in those 80 minutes did not begin that morning. It had been building for a very long time. Most people think they understand silver. They see it in jewelry stores. They read about it in investment articles. They hear it mentioned alongside gold in conversations about wealth preservation. They believe they have a reasonable grasp of what silver is and how it behaves. They don't. And that gap in understanding is precisely what made this massacre possible. Here is the first thing you need to understand. The silver that trades on global markets every single day is not primarily physical silver. It is not bars sitting in vaults. It is not coins changing hands between buyers and sellers. The overwhelming majority of silver that changes hands in the financial system exists only on paper. Contracts, futures, derivatives, digital positions representing silver that may or may not physically exist in the quantities being traded. For every 1 ounce of physical silver in existence, estimates suggest that somewhere between 100 and 250 paper ounces are traded in the financial system. Read that again, slowly, 1 physical ounce. Up to 250 paper claims on that same ounce. This is not a conspiracy theory. This is the documented structure of the modern commodities market, and it creates something extraordinarily dangerous. A system where price is not determined by the actual supply and demand of the physical metal. Price is determined by the movement of paper, by leverage, by institutional positioning, by the decisions of a relatively small number of very large players who can move markets not because they hold silver, but because they hold contracts. Now enter the futures market. Futures contracts allow traders to buy or sell silver at a predetermined price on a future date. On the surface, this serves a legitimate economic function. Miners lock in prices, manufacturers hedge input costs, institutional funds manage exposure. Reasonable, logical, necessary. But futures markets also attract a different kind of participant entirely. Speculators. Traders operating with extreme leverage, sometimes 10 to 1, sometimes 20 to 1, sometimes higher, who are not interested in silver as a metal. They are interested in silver as a vehicle for amplified returns. And when those leveraged positions begin moving against them, the math becomes brutal very quickly. A 10% move against a position with 10 to 1 leverage does not produce a 10% loss. It produces a 100% loss, complete account wipeout. And when enough leveraged players hit that threshold simultaneously, when margin calls start arriving faster than traders can respond, what follows is not an orderly sell-off. It is a cascade. This is what the data shows happened that morning. The initial move in gold created pressure. That pressure rippled into silver. The first wave of forced liquidations began hitting the market, not because traders wanted to sell, but because their brokers required them to. Margin call after margin call, position after position, all feeding the same directional move lower. And as the price dropped, more stop losses triggered, more margin calls arrived, more forced selling entered the market. Each wave of selling creating the conditions for the next wave, a self-reinforcing mechanical collapse that had almost nothing to do with the fundamental value of silver as a metal, and everything to do with the structure of the system built around it. But leverage and liquidations alone do not fully explain an $80-minute trillion-dollar event, because underneath the mechanical pressure, something else was present that morning. Institutional unwinding. Large funds, the kind that manage billions, not millions, had been carrying significant long positions in precious metals through what had been a historically strong run. When macro signals shifted, when certain geopolitical data points changed in ways these institutions had been quietly monitoring, the decision to reduce exposure did not come as a surprise inside those organizations. It had already been made. What the market witnessed in those 80 minutes was not panic, it was execution, calculated, coordinated in timing if not in communication, the kind of selling that doesn't happen because someone is afraid. It happens because someone already knows something the broader market is only beginning to suspect. And what exactly did they know? What geopolitical pressure had shifted quietly enough to avoid headlines, but loudly enough to move institutions worth billions toward the exit simultaneously? That answer lives in the data that most analysts were not discussing publicly, and it connects directly to a much larger economic signal, one that silver, uniquely among all assets, is specifically positioned to reveal. That is where part 3 begins. There's a reason serious analysts watch silver differently than they watch gold. Gold is monetary. Gold is reserve. Gold is the asset central banks accumulate quietly over decades, and governments hold as the last line of financial credibility. When gold moves, the world pays attention because gold speaks the language of institutional power. But silver? Silver speaks a different language entirely. And on the morning of this massacre, it said something that should stop every serious business person, every entrepreneur, every decision maker reading the economic landscape right now, dead in their tracks. Here is what makes silver unlike any other asset on the planet. Silver exists at a unique and dangerous intersection. On one side, it is a monetary metal. Like gold, it has functioned as a store of value across thousands of years of human civilization. It has been used as currency, as reserve, as wealth preservation, across empires that rose and fell while silver remained. On the other side, it is an industrial metal. Solar panels, electric vehicles, semiconductors, medical equipment, defense technology, artificial intelligence infrastructure. The modern industrial economy does not function without silver. It is not optional. It is not replaceable in most of its critical applications. It is physically embedded inside the technology that powers the 21st century economy. This dual identity is precisely what makes silver's price movement so uniquely revealing. When silver drops in isolation, when gold holds steady while silver bleeds, the market is not simply making a statement about monetary value. It is making a statement about the future of industrial demand. And industrial demand is a direct reflection of one thing: global economic activity. Now look at what the data was already showing before this collapse occurred. Global manufacturing PMI numbers, the Purchasing Managers Index, which measures the health of manufacturing sectors across major economies, had been flashing warning signals for consecutive months, not dramatically, not in the kind of way that generates front-page headlines, but consistently. Quietly, in the language of numbers that institutional analysts read every morning before the market opens, China's manufacturing output, which consumes more silver than almost any other single economy on Earth, had been showing contraction signals beneath the surface of official reporting. Europe's industrial sector had been contracting for longer than most mainstream commentary acknowledged. Even within the United States, certain leading indicators of industrial activity had been softening in ways that did not match the optimistic narrative being circulated in financial media. Silver knew. Silver always knows. Because silver does not trade on hope. It does not trade on narrative. It trades on the cold, forward-looking expectation of whether factories will be running, whether technology will be manufactured, whether the industrial engine of the global economy will be accelerating or decelerating in the months ahead. And on that particular morning, the signal was unmistakable. Then there is the dollar. The relationship between silver and the United States dollar is one of the most consistently misunderstood dynamics in all of financial markets. The two move in opposition, not always, not perfectly, but structurally and historically with remarkable consistency. When the dollar strengthens, silver comes under pressure. When interest rate expectations shift in ways that make dollar-denominated assets more attractive to global capital, precious metals face headwinds. And in the period leading directly into this collapse, the dollar had been receiving exactly that kind of support. Interest rate expectations had shifted, not dramatically in public communication, but in the forward pricing of rate instruments, the markets where serious money makes serious bets about the future cost of capital, something had changed. The expectation of monetary easing that had been partially supporting precious metals through their historic run was being quietly repriced. Institutional money reads that repricing before it becomes public knowledge, and institutional money moves accordingly. But here's where the signal becomes genuinely alarming. History does not repeat perfectly, but it rhymes with a consistency that demands respect from anyone serious about understanding markets. Go back and study every significant silver massacre of the past 4 decades. The 1980 collapse, the 2011 crash, the March 2020 liquidation event. Each one occurred not in isolation, not as a standalone precious metal story, but as a leading indicator, a precursor, an early warning system for broader market stress that materialized weeks and months after silver had already spoken. In 1980, silver's collapse preceded broader commodity and equity market instability that restructured portfolios globally. In 2011, silver peaked and crashed before a significant equity market correction arrived months later. In 2020, silver was among the first assets liquidated when institutional stress began, before the full scope of market disruption became visible to the public. The pattern is not coincidence. It is the market's early warning mechanism functioning exactly as it always has. And the analysts who were already tracking the current confluence understood something critical. This was not a single-factor event. It was not the dollar alone. It was not leverage alone. It was not manufacturing data alone. It was not geopolitical repositioning alone. It was all of them arriving simultaneously in the same 80-minute window, compressing months of building pressure into a single violent expression. That kind of confluence does not resolve quickly. It does not correct in a week and return to normal. It does not reverse simply because sentiment improves or a headline changes. Confluent breakdowns of this nature historically mark the beginning of an extended period of restructuring in markets, in capital flows, in economic activity itself, which means the question is no longer what happened. The question is what comes next. And more importantly, what should a serious business person, a strategic entrepreneur, a decision maker with real capital and real exposure actually do with this information? Because understanding the signal without a response framework is simply expensive education. That is exactly what Part 4 delivers. Everything covered in this analysis until this point has been diagnostic. The timeline, the mechanics, the signal, the history. All of it has been building toward a single unavoidable question that every serious person watching this right now must answer for themselves. Not tomorrow, not after the next data release, not after the market gives another signal that is somehow clearer or more convenient. Right now. The question is simple. Are you positioned for what is coming, or are you still reacting to what already happened? Because those two postures produce completely different outcomes, and the difference between them is not intelligence, not access, not luck. It is framework. The first thing serious decision makers must understand is the difference between noise and signal. In the aftermath of an event like this massacre, the financial media ecosystem floods with content. Opinions multiply. Predictions contradict each other within the same hour. One analyst calls it a buying opportunity. Another calls it the beginning of a prolonged collapse. A third introduces 17 variables that somehow lead to a perfectly neutral conclusion. None of that is analysis. That is noise dressed in the language of analysis. Signal is different. Signal is what the data showed before the event occurred. Signal is the manufacturing PMI numbers that had been quietly contracting for months. Signal is the dollar repricing that institutional money had already begun responding to. Signal is the technical level, the 150 exponential moving average on the hourly, and that broke with precision and delivered exactly the outcome the confluence suggested. The discipline of separating signal from noise is not natural. It runs directly against human psychology. Our brains are wired to respond to the loudest voice in the room. The most dramatic headline, the most emotionally resonant prediction. But the loudest voice in the room is almost never the most informed one. The most informed voice is usually the quietest. It speaks in numbers, in levels, in patterns that have repeated across decades of market history. Training yourself and training your organization to hear that voice above the noise is the single most valuable strategic investment a business leader can make in the current environment. The second framework serious entrepreneurs must implement immediately is capital preservation positioning. This does not mean liquidating everything and moving to cash. That is a reactive posture driven by fear, and fear-based decisions in complex economic environments almost universally produce poor outcomes. What it means is this. Every serious business person must conduct an honest audit of their current exposure. Not the exposure they think they have, the exposure that actually exists across their portfolio, their business operations, their supply chain dependencies, and their financing structures. Ask the hard questions. How much of your business revenue is dependent on discretionary consumer spending that contracts during periods of economic stress? How much of your supply chain runs through industrial sectors that silver signal suggests are heading into deceleration? How are your financing arrangements structured relative to an interest rate environment that may remain higher for longer than consensus currently projects? These are not abstract questions for economists. These are operational questions for business owners. And the answers determine whether the next 12 to 18 months represent a period of significant stress or a period of significant opportunity. Because here is the reality that separates great business leaders from average ones. Every major economic disruption in modern history has simultaneously destroyed wealth for the unprepared and created it for the positioned. The 2008 financial crisis wiped out institutions that were overleveraged and underprepared. It also created the conditions for some of the most significant wealth accumulation of the past century for those who understood what was happening and acted with discipline rather than panic. The 2020 market collapse erased trillions in weeks. It also handed extraordinary entry points to businesses and investors who had maintained liquidity, preserved capital through the volatility, and moved with conviction when the signal, not the sentiment, said to move. This moment is not different in structure. It is different only in its specific details. The underlying dynamic is identical, pressure building beneath the surface, a violent release event that catches the unprepared off guard, a period of uncertainty and restructuring that follows, and ultimately, always, without exception in modern economic history, a recalibration that rewards those who responded to the signal with strategy rather than emotion. Now specifically, what does the next 60 to 90 days likely hold? Based on the confluence of data points examined across this entire analysis, several developments warrant serious attention. Dollar strength is unlikely to reverse quickly. The structural conditions supporting it, interest rate differentials, global capital flow patterns, geopolitical uncertainty driving safe haven demand, remain intact. This continues to create headwinds for commodities broadly, not silver alone. Industrial demand signals suggest the global manufacturing slowdown is not yet at its floor. Additional data confirming contraction in key economies over the coming weeks would validate what silver's price action already indicated. Businesses with significant exposure to industrial supply chains should treat this period as a window for stress testing rather than expansion. Precious metals. Volatility is not finished. Events of this magnitude rarely resolve in a single session. The structural imbalances in the paper silver market that enabled this massacre have not been corrected. They have simply expressed themselves. The conditions that created this vulnerability remain present. And perhaps most critically, institutional behavior in the coming weeks will be instructive. Watch where large capital moves after events like this, not where media says it should move, where it actually moves. Because institutional repositioning in the aftermath of a major dislocation event often reveals the next phase of the macro story before it becomes visible to the broader market. Finally, the one question every serious entrepreneur must answer before the next wave arrives. Not what is silver worth, not when will it recover, not whether this was manipulation or organic market forces. Those questions, while interesting, are not strategic. The strategic question is this: if the signal that silver sent this morning is correct, if global industrial demand is decelerating, if monetary conditions are tightening beyond current consensus expectations, if the broader market stress that historically follows events like this one does materialize over the coming months, is your business, your portfolio, and your financial positioning built to survive that environment? And more than survive, to capitalize on it. Because the entrepreneurs and business leaders who build the frameworks to answer that question honestly, who stress test their exposure, preserve their capital through periods of volatility, maintain the liquidity to move when genuine opportunity appears, those are the people who emerge from economic disruptions not diminished, but stronger. Silver sent a signal on that morning. $1 trillion in 80 minutes was not an accident. It was not random. It was the market speaking in the only language it has ever used. The only remaining question is whether you were listening. This has been Financial Crisis Explained. If this analysis delivered value, share it with someone who needs to hear it. Drop your thoughts in the comments below, and we will see you in the next one.